Hey everyone, thanks for joining us. I have an awesome reverse loan officer, Trent Tilman, here with us today. Trent, thank you so much for joining us. I'd love it if you'd introduce yourself to the audience.
Sure, Christina. Thanks for having me. Um, I'm Trent Tillman. I live in just outside or north of Denver, Colorado, and I work with Lending Key Mortgage Group, which is a branch of Nexa Mortgage. And I've been back in the mortgage business since 2016 and focused on reverse now for a little over the past year.
2016 doesn't quite do you justice. So I heard earlier, you, like me, started with your dad. Your dad was a mortgage broker, right?
He was in Orange County. And I originally got my license in 92. And as you know, being from California, it wasn't really a mortgage license per se, but the real estate license. And actually, I think in about 98, I actually had my broker license as well there. And I worked in while finishing college and for a couple of years afterward, and then jumped into financial markets for the majority of my career. I dating myself, but I was on the Pacific Coast Options Exchange when they had one, and as a market maker. And then I moved to a muni bond firm and traded muni bonds for a few years. And then I jumped over to short stint at commercial real estate and then back into the equity markets as an analyst for a hedge fund. And I did that and then ran my own research related website for about, well, till 2016 when I jumped back in.
My gosh, that must give you a really good overview of how everything here in the mortgage industry works.
Sometimes a little too much.
I bet. You
I,
could probably school us on some stuff.
I get a little, have to pull myself back so I don't get too far in the weeds trying to explain things. But overall, I think it's a good background.
Well, when you're doing a reverse mortgage and you're talking to financial planners, I'm guessing that gives you a huge advantage.
It definitely does. Once I get my foot in the door and can actually talk to them and give them my background so they understand that I know what they're going through and I know, for the most part, what I'm talking about. And so it definitely does help.
Oh, that's awesome. I think that's really important. A lot of financial planners and mortgage people don't always understand each other. And so for you to be able to have that background and say, hey, no, this is legit. This is how this works and relate it to things they know. My gosh.
Right.
So that brings me to my next question. What drew you to reverse mortgages?
It really was a piece that a training that I got from FAR, Finance of America, and it was called Preparing for the Rebound. I know that you're familiar with it. And essentially, they were talking about sequence of return risk. And the quick and dirty, without getting too detailed, is the fact that on taking the portfolio returns for a retiree that has to withdraw from their portfolio, it's a double whammy per se if they have to withdraw after a down year in the market, and especially if it's early in their retirement. So their case study was from 73 to 03, and it took out 2008 out of the equation, but also looked at 73 and 74 as 2 years that were both down on the S&P. And in looking at that, it showed in the example somebody that had a $400,000 portfolio, and if they were to do their standard, I think it was 3.5% or 4% withdrawal out of that portfolio, starting mixed with the Social Security, they would have needed 26,000 at the beginning of their retirement, and then inflation adjusted up 4% every year. They would have run out of money in 23 years.
Okay.
And in doing the same with doing a coordinated withdrawal strategy by setting up a reverse line of credit, and every year after a down year, taking money out of the reverse line of credit and leaving it in the portfolio to be able to rebound, then not only would they have had been able to live the full lifespan of the 30-year time frame that they were looking at, but at the end of that period, they would have actually had $1 million left over in their portfolio versus zero.
$1
So,
million versus zero by just using this one strategy.
exactly. And that was the hook for me.
Yeah. And what a time, because we're seeing that today. I mean, inflation, do you know the inflation numbers right now?
Well, luckily, we're starting to see them tick down somewhat. And we're still far away from what the Fed's targeting at 2% on core. But, we're off of the highs of whatever we were at, 7 or 8%. But with that being said, as we know, the S&P was down significantly last year. We've had a tiny bit of a rebound this year, but most economists are projecting that we're going to go into recession later this year, and they're projecting that we're going to have another down year in the S&P. So the funny thing is it correlates very similar to their whole scenario of the 2 years, 73 and 74, correlating to 22 and 23 if we do have a down year. And that can significantly wipe out somebody's portfolio if they have to take withdrawals.
Well, and especially somebody who doesn't have time for it to come back, right? Somebody in their 80s or 70s.
Right. Exactly.
That is an amazing strategy. So I love that you bring that up, because so many people think, oh, I don't need to do a reverse mortgage. And and what you're talking about, yeah, you don't need to, but do you want to have zero in 23 years, or do you have $1 million in 30 years?
Exactly.
You don't need a reverse mortgage, but gosh, would you want one?
And, our problem's not the word, but our, what's the word I'm looking for? Challenge is getting that word out, because you're exactly right. I mean, that's what we run into all the time, right? I don't need a reverse mortgage. Well, yeah, you don't need one, but you don't know all of the other options that it can bring you.
Yeah, I know we've talked about this offline, but there's a study, Barry Sachs and John Salter, I think. There was a study that showed take a reverse mortgage early and you'll have much, much better returns, or take one as the last desperate measure, as people think that, that's old placement. That's like 2005 thinking. We're in 2023. It's not appropriate anymore to think about a reverse that way.
Yeah, exactly. I use that article from they published that in December of 21 in the Journal of Financial Review, and I try to get that in front of every financial advisor that I talk to.
That's huge. Now, my experience with financial planners, a lot of the time, is they don't always keep up with understanding the reverse product. Do you see the same in your practice?
I see a discrepancy. Either some seem to really know it and accept it, and others that just really are the opposite extreme and really don't know it at all. And it's a matter of trying to get them to actually pay attention and learn it.
Yeah. Yeah. And it's a little bit of an uphill battle for us reverse people, because up until 2011, there was a law in the books for the financial planners that said you shouldn't talk about reverse mortgages. And to me, I'm like, oh, what a horrible law to gag them from talking about a financial tool.
Right.
And in 2011, it was an okay product. 2015, it became a really good product. 2017, 2018, now it's a really, really amazing tool. But some of those financial planners are still under the impression from prior to 2011 that, oh, we shouldn't be talking about reverse mortgages.
Right. Right. And there's still some that even company-wide, they're being deterred from talking about them. And so that's the other, I know that some of the people that you were talking about that were part of the studies have really been lobbying hard to get in with at the corporate level to explain how it's really their fiduciary duty to look at this as part of the overall strategy. Because as we know, I mean, this is the biggest piece of wealth across that demographic. And the fact that a lot of advisors are not even considering it as part of the overall retirement strategy is, in my opinion, a crime.
I don't disagree. There's an idea out there that they might find themselves in hot water when people's retirements aren't working out well. And well, why didn't you bring up this tool to take advantage of, I think it's $12 trillion held in senior home equity right now.
Right.
And we have a 4% market penetration, which means there are 96% of people who could qualify and do a reverse, and they don't know about it, or they're afraid of it, or they've heard bad things, or maybe like there's another video for, if you guys are interested, there's another video on here where a loan officer told her dad about it. He went to his financial planner, and his financial planner said, "Oh, no, you don't need that. You don't want that." And so then the client, her dad, learned more and went back and yelled at the financial planner and said, "I want this. Why would you tell me not to do it?" I think we're going to see so many more cases like that in the future. It's unfortunately, they don't have an incentive.
Right.
Financial planners don't get paid if they suggest a reverse mortgage, but they really do help their clients.
Well, and in reality, if they look at it for the longer term, they do get paid in certain situations, in the sense that they are helping them keep their retirement savings for a longer period of time. And as we know, most advisors are paid nowadays on an assets under management. So when their assets dry up early because they're using it as a last resort, their pay has gone to zero as well. Whereas if they, look to understand this and implement it early, then it can be a win-win across the board.
That's such a good point. And even in the case you talked about, right? If the parents pass away and there's $1 million estate, the kids probably need somebody to manage that money.
Right.
Yeah. I hope everything we're doing can start to change that thinking. And, unfortunately, sometimes it's the borrowers who have to go to their financial planner and say, "Hey, I like this. You need to pay attention to how this thing actually works."
Right. Right. And I love that what you're doing and trying to bring the community together to spread the word across the board.
Thank you. Thanks for being part of that community. It takes an army, man. All right. So what's one situation of a reverse mortgage changing somebody's life that you just add, beyond the $1 million to zero, that it's a case study. That's awesome.
Right.
Sorry, my cat's in the frame. But yeah, tell me about one situation where you're like, okay, the reverse is so powerful. People need to hear about this.
It kind of goes back and forth. One recent is the simple situation that I had a borrower that right now owes just about $100,000 on a $500,000 property and is looking to retire soon, and was being advised to take a standard line of credit and hold on to it for 10 years until the last minute and then withdraw on it. And then he'd have access to roughly $150,000 that he was approved for to draw on at that period of time. And we sat down, went over the numbers, and showed him that we could take out the reverse now, pay off that $100,000 and save him $800 a month that he could plug into his retirement account and help grow that. And at the same time, he'd have access to a line of credit of just under $100,000 that in that same 10, I think we looked at 10-year period, it was well north of 200,000, assuming of course that rates stayed where they were. But in that scenario, he'd have access to those funds while also having a greater retirement savings on the other side.
Okay, so you touched on something I want our audience to hear. I've got to move this cat, sorry. I want our audience to hear. So you touched on that the line of credit did not stay the same the whole time. So can you kind of educate our audience how that works?
So the line of credit, the unused portion, will grow at the rate of interest plus the mortgage insurance 0.5% over time, and it cannot be frozen like a standard line of credit, and you have access as long as you're in the home, and so that will grow on until you die or leave the home. And so it's a great piece for all sorts of different you can use it for anything you want to, obviously, but it's a great insurance policy that you can set up. I think it's what is it? You probably know better than me. Is it 20% or less than 20% have any long-term care policy?
I don't remember the stat. I have another video on here that talks about it, but yeah, it's not that many.
Over 70% are expected to need it. So this is a great hedge on that, to set it up early and let it grow, because at some point or another, the majority of us are going to need access to that. And obviously with healthcare costs constantly rising, that's one case, let alone, all the other possibilities of it. But it's just a great access to funds that you wouldn't have access to later, because you wouldn't be able to, if you didn't get the line of credit now, a standard line of credit, there's a greater chance that you're not going to qualify for it later.
Well, and people don't think about that standard line of credit. Like, let's take a HELOC, right? You can draw on it for 10 years and then it amortizes and you have to pay it back for 20 years. If I'm 67, am I more likely to be able to make this higher payment at 77?
Right.
It boggles my mind why, the credit unions, banks, other places kind of target seniors, because they do have equity. It's easy, it's cheap, it's fast, but gosh, it's not the right solution.
Right.
For most people. In some situations it might be just like a reverse. There's some situation where it's not the fit, but oh my gosh.
Now, luckily, there are some loan officers out there at the credit unions and everything that have the experience and realize that. And quite honestly, I have a good referral partner at one of our local credit unions that he used to be able to do reverse in his past life. And now he has turned a handful of their clients at the credit union over to me saying, hey, you might want to look at this instead.
That's amazing.
Yeah.
That's awesome. I'm so glad that you have that relationship for him to say, hey, I can't do this, but that's the right fit. Let me pause for just a minute, kick this cat out. I apologize, Trent. Sorry about that, Trent. He really wanted to be part of our conversation today.
I liked him in there.
He was distracting me. So where were we leaving off? There's so much to this that we could talk about. But the credit unions, the big banks don't offer reverse mortgages. So in order to get educated, people have very few options. They have to come to somebody like you who has invested the knowledge and the time to learn this stuff.
Right. And quite honestly, they can be good referral partners for us, because people don't know where to go. The people that do want to know about reverse mortgages a lot of times don't know where to go. And so what's the first step? They go to their local bank.
Yeah. Yeah, it's a really good point. And hopefully somebody at the local bank knows you, or some reverse professional who really knows what they're doing and can refer them over.
Right.
If they don't, hopefully they've landed on our channel.
Exactly.
Go to the internet, find information from loan officers. Okay, so question. Are you seeing more people being open to the idea of a reverse mortgage from like your forward business, from your past contacts, just seeing the whole idea about it change?
Um, I am seeing a lot more curiosity about it, and but still more coming from the referral of somebody going to somebody else to that they're not necessarily seeking out the reverse. I unfortunately I still see personally I see more when they're seeking the reverse, it's more of a matter of becoming it's still that last resort that you mentioned. And in so a lot of cases that I'm seeing it's from realtors that we're talking to saying that we have, and it might be, a friend or family member that they're saying, hey, we learned about this, you really should talk to Trent or somebody else about it.
Yeah.
And then, it's an uphill battle to teach everybody about this, but it's just getting the word out and the education, because I think more people, they're curious, but then they don't know where to go. And unfortunately, as you know, there's a lot of bad and misinformation out there. And, there's a lot of experts that like to give their opinion that really have no knowledge whatsoever about how it works. And so, yeah, I think there's a lot more people that would be willing and interested in finding out more about it, but they're scared still.
If you could say something to those people, the fear-based ones who don't want to look into it, what would you tell them?
I would tell them that let's either meet or come to a seminar that I'm having, and please bring family members, especially kids, and your financial advisor if you have one. So you're not just hearing it from me, but you can, and we can have an open discussion of what are your fears? How do they work now? Because a lot of the misconceptions, as you said, I mean, there's been so many changes since 2015 that people still hold on to 20 years ago. And it's, I think it's just educating the entire tribe.
Yes. Okay, so myth busting, because there's so many misconceptions. What are a couple of the misconceptions you want our audience to come away from this video knowing are not true?
Uh, the bank doesn't own your home. um, your heirs will not be on the hook. You're
Oh,
not gonna,
tell us more about that. That's an awesome feature.
so a lot of people still feel, or they heard through their Uncle Larry's friend that read something about it, that somebody lost their house or their heirs, they owed more when after they passed, and their heirs had to pay it back, or they will be on the hook to pay it back. And that's just not true. They are all non-recourse loans, and the majority are FHA, HECMs, home equity conversion mortgages, and that's why you pay for the upfront mortgage insurance, because FHA will take over the loan if it gets to that point, and you will never owe more than what the home is worth. And as a matter of fact, it's typically what they'll give roughly about $3,000 in kind of a cash for keys program. In worst case scenario, if the home is worth less than what the mortgage balance is, they can just walk away.
Right? It's fascinating. It doesn't even show up on credit reports. What mortgage doesn't show up on your credit report? Like, how much more non-recourse do you want it to be? It doesn't show up on your credit report. It's not a personal liability. The house is the only collateral. So in the situation we started with, here we go full circle, right? Now your portfolio has $1 million. And let's say the person passes during a down market and maybe the home isn't worth as much as the mortgage balance. Well, the heirs still get to inherit that $1 million, don't they?
Right.
It's mind blowing when people say these things. I'm like, no, worst case scenario is you just made out like a bandit. I mean, it takes a lot for it has to be a market crash. You have to live a very long time. Interest rates have to be crazy high. We know it's a rare situation that'll happen. Most of the time
Right.
there's equity, but still, you want to
Well,
know what if.
and I think that's another good point. I mean, people don't really understand or realize that typically you're going to be taking, I mean, especially with rates as high as they are now, you're going to have access to 35 to maybe 55% of the home value. You're not taking out 80% of the home value. So the chance of being underwater are great. I mean, in reality, just like you said, you have to live either really long and have home prices drop significantly for that to be the case.
Right. And even like I started my career when rates were about what they are today.
Mm.
So I think people have this misconception that rates are high, but the truth is we had economic conditions that pushed rates to an uncrazy, crazy amount that was just way too low. That's not sustainable. That's not realistic. Interest rates today aren't really that high. We just happen to be coming off of a market where they were held down artificially for far too long. And
Right.
you're going to understand that stuff much more than I do. Is there anything on that you want to share with our audience?
Um, the only thing on that is you're 100% correct as far as these are not high rates. The affordability overall on which is more toward the forward market than necessarily reverse is obviously a lot worse because home prices went up so great. But one of the things is once this market settles down, if you look at the spread, because we all go off of the 10-year treasury for mortgage rates, that's what it follows. And the spread historically has been about 1.75% to 2%. And we're well above that right now. So if we just get a decrease in the volatility of in and of itself, we should see that spread normalize. And I mean, we can see a good half a point to full point in a drop of rates with no change in the 10-year treasury, just because that the spread is abnormally high at the moment.
So for those of our audience who don't understand what that spread means, can you go into what that means to them?
Sure. So I'm just talking about the spread between what the actual 10-year treasury rate is right now. So I don't know what it is today, but let's say 345 roughly. And what the 30-year treasury rate is. And historically, that difference has been roughly about 1.75% to 2% on average. Right now, 30-year mortgage rates are really kind of in the 6.5-ish range, something like that. So we're closer to the 3% on that spread. So we have room for rates to come down, even if the 10-year treasury doesn't move. And there's a couple reasons for this, and I don't want to get too into the weeds, but one is simply volatility. When things are volatile and there's a lot of change with the interest rates fluctuating significantly, then there's more risk, and therefore the spread widens because there's a demand for a higher rate from the lenders. And the other piece is that in the past few years, with the extremely low rates that we had, one of the things was the Federal Reserve was going in and buying mortgage-backed securities. And they were also all the refinance money that was paying off what they held was going back in to buy more. So they were artificially lowering the rates just by simply being really active in that mortgage-backed security market. And that was quantitative easing. And since they have backed off on that and aren't doing the quantitative easing anymore, then naturally that spread has gone higher because they're not in there buying a significant portion of those mortgage backs.
And that affects us in reverse, even though we're not quite on the same indexes, it still affects us in reverse because it all matters. And
Right.
one of the things I that just popped into my head, I was like, oh, we should talk about that here. Reverse mortgages, the majority done are ARMs. And people have in their head, again, another misconception. They think, oh, fixed rate mortgage, that's safer. But in reverse, we do a lot of adjustable rate mortgages. Do you have anything to say on that? What, somebody who's like, oh, an ARM, that's terrible.
Um, my opinion right now is that you would want to be in an ARM because the likelihood of rates going lower from where we are in the next 12 to 24 months, especially if we do have a recession at the end of the year, like the majority of economists are predicting right now, and even the Federal Reserve is basically telling us that that's going to happen. When that happens, rates come down. Just historically, that's what happens. And therefore, getting into a fixed rate at the moment is not as advantageous because sure, you could, refinance down to a lower rate if they drop enough, but on an adjustable, it's going to come down automatically. So I think overall in that scenario, you're better off being in an adjustable rate. And with that said, we've seen such a move so quickly from the lower rates to where we are now that the likelihood, especially with inflation coming down and the economy starting to show signs of slowing, the likelihood of them going higher from here anytime in the near term it's just not very realistic. It would take for lack of better, an act of God that's outside of the normal markets.
So you touched on a really good point. In reverse, if you're in a HECM, you actually have to wait 12 months, maybe 18 months, depending on your lender, to even refinance. So the person who says, oh, well, I'll just refinance, like, maybe.
Right.
You're going to be held in that for a little while.
Exactly.
All right, Trent. Well, I really appreciate your time with us today. We're getting towards the end of our session.
One quick last thing also, that adjustable, the line of credit, the HECM line of credit is only available on that on an adjustable rate. And it's such a great product that I would hate for people to miss out on that because they wanted to focus on that fixed rate versus adjustable.
That's such a good point. The other part with that mix, people should understand while we're here, the fixed rate, they have to take all of the money as a one-time lump sum at close. That's a closed-ended mortgage because it's a fixed rate. And so that forgoes the opportunity of having monthly payments to you. Monthly payments for a certain amount of time, monthly payments all the way till you pass away, move out, whatever that looks like, and that line of credit. And that line of credit, as interest rates are higher, the example you gave earlier was that line of credit was growing quickly. And that's because of the high interest rates. It's like, it's a good thing for some cases, not every case, right? If your mortgage that you're paying off is really, really big, that's not going to be your situation. But if you have just a small mortgage and you have a large line of credit, gosh, you want to do that when interest rates are high because that line of credit is just going to grow so fast. I just thank you for bringing that up and stop me before we end it, because that is really important information. Like what, sometimes when people call an 800 number off of various type of marketing, sometimes they'll get a quote that's just like, here, take all this cash now. And the person will eventually find you or me, hopefully, and they'll go, well, here's my quote. Can you compete with this? And we look at the quote and go, why would you do that?
Right.
You're going to incur interest on $200,000 from day one. Do you need this? What are you using that for? No, I don't need it. I don't know. That's just what they sent. Can you match it? I'm like, no, absolutely not. I would never match it. let's put you into something that actually makes sense, where you're not incurring interest from day one on money you don't want or need. But
Right.
like you said, that brings in the topic of adjustable rate mortgages. So people have to be a little educated on how this stuff works. All right, you got me on a tangent. I love this. So the other part of why adjustable rate mortgages get such a bad rap is because they had a payment attached to them in 2008, 2009. 2023, here we are with reverse mortgages with no payments. It's
Right.
not like when the rate adjusts, you have the payment adjusting. It's not the same.
Right. Right.
So, all right, thanks for that.
Or balloons back then. So anyway, that's another story.
We should probably have another session on that. All right, Trent. Well, to end our session today, I would love for you to tell everybody, if you could change the American retirement, how would you change it?
It's not necessarily changing the retirement itself, but changing the American mindset for retirement. And that is, we spend our whole lives being told, buy a house, pay down the mortgage, you want to retire with no debt. And at the same time, we're trying to save as much as we can to live the retirement that everybody envisions of whatever your interests are, of golfing and traveling and everything else. But the reality is most people are not living that type of retirement. The good news is people have, in general, paid down. I mean, baby boomers are the highest owners of housing in the country, and the majority have little to no debt on those properties. But at the same time, there's only 27% of people out there that think that they have enough saved for retirement. And the biggest fear out there is outliving assets. It's bigger than the fear of death itself. And therefore, I think that there needs to be a change, because the house is an asset. The assets are available. It's just that old school mentality of, you can't tap in to that equity because that's a debt. And it's kind of going against the, I don't know if I can use this on the show, but the Dave Ramsey of no debt and all debt's bad debt. But not all debt is bad debt. And having the access to those funds can literally change somebody's life for the better through their retirement. And I think it's literally just changing that mentality of, it's all should be considered one pool of assets that you can access. I mean, why can we save all this time for retirement and there's no problem drawing on the retirement because that's what you saved it for? But we can't think about tapping into the equity of our home. It doesn't make sense.
Really, really good answer. It's the biggest investment most people have ever made, and the best one.
Yeah.
And then, no, we can't touch that. I hope the country can heed your words here and be able to change their mentality, because I think it's needed,
Yeah.
Great answer. Well, thank you so much, Trent. If somebody wants to get in contact with you, how would they get in contact with you?
I would say the easiest would just give me a call, 415-640-7130.
All right, very cool. And there's a link below the video to get in contact with Trent too. So thank you so much for being on here, and we'll see you next time.
Well, thank you. Thanks for the time. See you
Bye,
soon.
everybody.
Bye.